Hello, everyone. Welcome to TSAM Digital. My name is Lewenza, and today I'm being joined by Ryan Lewenza, Senior Financial Advisor and Portfolio Manager at Turner Investments Raymond James. Welcome, Ryan.
Hi, thanks for having me today.
Thank you, Ryan, for being here. So before we get started, Ryan, do you want to say a couple of words about yourself and about the work you do?
Sure. So I'd say a couple of things. Number one, I'm a portfolio manager for a large investment practice here in Canada. Our banner is Turner Investments, which is led by Garth Turner, who was a very prominent member of Parliament in Canada, wrote a number of books, and he's kind of a big profile here in Canada. And then he went out and started this investment firm about 10 years ago. And then I basically lead the investment side of that. And we're just looking after everyday Canadians, retail investors, looking after their money, protecting it in these really tough times, and then growing it. We use a very simple, balanced approach where we invest some in equities and some in bonds, and we're all about balance and diversification, and just kind of steady Eddie types of portfolios. And so that's what we're here for, just to look after Canadians.
Wonderful. Thank you, Ryan. And so today we wanted to do a Q&A around the current environment of inflation, which is obviously on everyone's minds. And first off, Ryan, what does this mean for portfolio managers? And do you have any short-term, long-term projections for 2022?
Yeah, what we're seeing on the inflation front is really, really a big deal. So for the last decade or 20 years almost, we've been in a secular disinflation environment where we've had low inflation. So keep it simple. For the last 10 years, we've had inflation Canada, US of roughly about 2%. And when you have low inflation, you have low interest rates. And so in that environment, there are certain investments that do better. So in a low interest rate, low inflation environment, technology stocks do very well. And so that's why the S&P, which has such a large technology weighting, has been the best performing global market for nearly a decade. But now we're in a completely new environment. We're in an environment we haven't seen since the 1980s. So, many of your listeners and viewers may remember that back in the 80s, we had inflation at 15, 16, 18%. Now, I don't think we're going back there, but we are at the highest inflation levels that we've seen in decades. So in the US, it's about 7% year over year. In Canada, it's about 5%. So we're in a new environment. So in a new environment with high inflation, what worked back then for the last 10 years may not work now. And so we have to make changes to the portfolio based on this new high inflation environment. So it has a number of implications on how you structure portfolios. What are the equities that you have? How do you tweak the bond portfolio to get you through this high inflation environment? So it's a big deal.
Absolutely. It is a big deal. And I wanted to ask you really, how can portfolio managers succeed in this new environment? Are there any new asset classes perhaps that can provide opportunities?
So a couple of key things when we're looking at portfolios. So let me back up here. So we kind of adhere to that kind of KISS principle, keep it simple, stupid. We try not to get too complicated here. And so what we do is we combine equities with fixed income. That's that balanced approach I was mentioning. So, a balanced portfolio, roughly 60% in equities and 40% in fixed income. By the way, we only invest in exchange traded funds, ETFs, no mutual funds, no individual stocks. So that's the playbook. That's what we have to deal with. So when we're looking at the portfolio, first on the fixed income side, you need to make changes to the allocations. So in a rising interest rate environment, by the way, the Bank of Canada just hiked interest rates yesterday. The Federal Reserve is going to hike on March 16th, and I think we're just getting going. Currently, the market is pricing in 6 Fed rate hikes for this year. I think with this terrible invasion of Ukraine, we're probably looking closer to 4. But the point is, rates are going up in this high inflation environment. So against that backdrop, in the fixed income, most importantly is you need short-term bonds. This is not the time for long-term bonds, because when interest rates go up, bond prices go down. Now I'm talking about duration. You want shorter-term bonds because they're less impacted by rising rates. Number 2, in a rising rate environment, you need more corporate bonds. Corporate bonds tend to outperform government bonds in a rising rate environment. And so we've been reducing our government bonds, particularly the long-term ones, and adding to corporates. So that's the second thing you should do. Number three, very important. And this may speak to your like asset classes or new things you should have. You need to have floating rate bonds. Okay, so this is a position that we put back in the portfolio a year and a half ago. In the summer of 2020 and COVID, we put floating rate bonds into the portfolio because I saw a recovery unfolding. I saw all the tremendous amount of monetary stimulus being injected, and the natural kind of connection was that inflation was going to go up. So floating rate bonds, what are these? They're specifically what we call bank loans. So JP Morgan does a big loan to a small, medium-sized company, $100 million. JP Morgan doesn't want to sit on that entire $100 million. So they'll sell 30, 40 to investors. That's what we're buying. And so bank loans are floating. So as the Federal Reserve is hiking interest rates, those creditors, those people that have those loans, have to pay higher interest. So a floating rate bond is a natural hedge on inflation. Keep it simple. As the Fed's hiking, we're going to get more interest payments. So you want short-term bonds, which are less impacted by raising rates, high-quality corporate bonds, and you want floating rate bonds. And so those are some of the things that you do on the fixed income side. On the equity side, you need to change the portfolio. Okay, because again, what worked then may not work now. So we are really I wouldn't say bearish, but concerned about technology stocks. They don't like rising rates. So I see a couple of key themes that you need on the equity side. Number one is you need more commodities. Okay, so the S&P 500 has a low commodity weight. And so your investors, viewers should be looking at more commodities. So that's great for Canada. Roughly a quarter of our GDP comes from resources. 30% of our index, our Toronto Stock Exchange Index, is resources. Look, the TSX is flat year to date. The S&P is down 9. So if inflation is going to go up, commodities are going to benefit. So you need more commodities. And then the other investment theme especially for U.S. investors, I think, is value stocks. So for years, growth has crushed value. We think we are seeing a major trend change, not something that's going to last a couple of months, that could last a couple of years. So value stocks, which are more concentrated in financials, in resources, energy, we think those are going to do better. Value is very cheap. It's the cheapest we've seen in over a decade. They do better when interest rates are rising. They've been out of favor. So just to recap, more commodities on the equities, more value stocks. That's, I think, the way you want to position a portfolio in this higher inflation environment.
Thank you so much for that. It's really insightful and just really, really interesting because we're going through this huge period of change and transition, right? So any words of wisdom that you want to leave with your peers, maybe?
Well, I would say one is that, again, you need to review the portfolio because people can get stagnant. And so you keep with the things that are working. But if you're going through these major trend changes, then you've got to adjust the portfolio. And so that's reviewing the holdings that you have, having some more value, having more commodities. Secondly, looking at your geographic weights. The S&P has been the best performing market. But now what we do is we look at relative strength a lot. So we compare one market to another. For the last 10 years, the Toronto Stock Exchange has been a relative underperformer. You know what? It just broke out. And so if this trend could have years. So your investors need to look at their geographic weights, look at some of their holdings and make some adjustments. And then I'll make two more important points. Number two, the market easily could go down over the next little while with this terrible and horrific invasion. It looks like they're about to go into Kyiv. It's going to get bloody. It's going to get worse. Similarly, I think the Russian economy is in real trouble. They have half the reserves they thought. We're seeing the ruble decline. Inflation's about to unfold. I think things are going to get a little bit messy here with the Russian economy. But note the Russian economy only represents 1.5 of the overall world economy. So I do think we could see a little hit to economic growth. Definitely not good for the markets, but we're going to get through this. I do not see a major economic downturn coming. So you got to stay, don't let the emotions take control. Turn off the TV. Try not to get all emotional about what's happening. Recognize that Russia's a smaller economy. And then the last point here is that, yes, we could see a little bit more short-term volatility, but I strongly believe the markets are going to recover. And I'll leave you with one statistic. I went and reviewed every military conflict over the last 50, 60 years, excluding the World War I and II. I don't think those are good parallels. And in every single conflict, the Cuban Missile Crisis, the first Iraq invasion, 1 year later, the S&P was up in every instance, and on average is up 27%. So what that tells us is to stick to your long-term plan, make these adjustments, don't get emotional, stick to your long-term plan. We'll get through this. And I feel very confident in a year from today, the markets will be higher because we always get through these. So those would be some of the investment tips and more of the almost psychological behavioral stuff that we need to, just don't let your emotions get a hold of you. That's when we make bad investment decisions.
Amazing. Thank you so much, Ryan, for your words of wisdom and for the encouraging note, because I think everybody really needs it right now. And so thank you so much. And actually, let's meet again in 1 year's time and review and see where we are.
Sounds good. I'll be here.
Amazing. Thank you.